Hey, welcome back. In today's video, I want to talk about a new report from Realtor.com just announced a couple of days ago. This is actually one of the first reports I've seen which covers the entire month of June. So for example, according to the National Association of Realtors, they will not have June's numbers until July 23rd. So in today's video, I'm going to talk about asking prices, inventory, new listings, and much, much more. I'm also going to share how these numbers compare to pre-pandemic levels. So hope you guys get a lot of value in today's video. And of course, if you do, please hit the like button. Hope you guys like my new studio just for today though. Let's first talk about inventory levels. Some big changes, especially compared to the past several years when in 2021 and the early parts of 2022, inventory basically went down and of course caused home prices to absolutely skyrocket as well. We also saw that in the second half of 2020 as well, of course. Anyway, when looking at the amount of houses for sale, and this, by the way, this whole report only looks at existing houses, so excluding brand new home construction. So there was approximately 36.7% more houses for sale this June compared to the same time frame in 2023. So year over year, we're up by nearly 37%, marking the 8th consecutive month of annual inventory growth. So inventory on national level has been increasing compared to the previous year for 8 consecutive months. This is also an acceleration though as well from May, their last report, which saw a 35% year-over-year increase. Now it's up by 37%. So inventory is not skyrocketing like we saw in 2022, but it's great news to see that inventory is rising because that would put more downward pressure on home prices. But right now, of course, we have all-time record highs for home prices as well, but also a decrease in rates as of today, which is on Thursday, though, which I'll share with you guys in a little bit. In any case, when looking at inventory compared to the typical June levels of 2017 through 2019, we're still down by 32.4%. That is a slight improvement, though, from last month of 34.6% gap. So in other words, the rate of inventory has been rising faster, this year compared to pre-COVID levels. So here's a look at that. This line right here is 2024. The pink line is last year. 2022 is this orange line. 2021 is right here at the bottom. And pre-COVID levels is above 17, 2018, and in red, 2019. So looking at inventory, again, we're up by about 37%. It has been rising compared to pre-COVID levels, but not rising as fast compared to 2022. As I mentioned in previous videos, inventory started to skyrocket back in May of 2022, whereas this year, we are seeing the growth of inventory rising faster, much faster compared to last year, but not rising at the same rate we saw in 2022. Now, speaking of that, let's get a little bit nerdy here. I want to share my own analysis of their data to kind of compare not only year-over-year changes and also compare the same time frame in 2017 through 2019. I also want to share the rate of increases because, again, back in 2022, inventory absolutely skyrocketed, which caused home prices to fall greatly in the last half of the year. Let me just share that with you guys really briefly here. So back in January, this, by the way, is all data from Realtor.com, and I just added these figures right here to provide my own analysis here. So 2022, and of course, the reason why I'm talking about this is because this was the time where we had a correction in home prices back in, I think it was late 2022, the first time we had a decrease in home prices on a year-over-year basis. And again, the reason why I'm talking about this is because in 2022, inventory skyrocketed, which caused home prices to decrease on a year-over-year basis in early 2023, the first time in over 10 years that it happened. So in my opinion, it's very important to kind of get an idea about what happened in 2022. How's that compared to this year? So here's what happened in a nutshell in 2022. Inventory doubled from January through October, went from about 377,000 houses for sale. By the time we hit October, a giant increase up to 752,000. So inventory doubled in that time frame. And it started to increase big time starting in May, up by 27% compared to January. And this June increased by 52% compared to January. And also, as you guys can see, in July, another big increase going from 573,000 to 691,000. an increase of 83% from January that year through July of 2022. Now here's what we're seeing this year. Inventory so far this year, this is January compared to June this year, has increased by 26%. So we have approximately 174,000 more house for sale by the end of June this year compared to the end of January this year. Compare that to last year, inventory was flat. So basically the same number of houses for sale in June 2023 compared to January last year, down by about 2,500. But again, in 2022, inventory skyrocketed up by 52% from January through June that year, up by nearly 200,000. Much different compared to the 26% increase we're seeing so far this year. So in a nutshell, inventory is growing much faster compared to last year, but not as fast compared to 2022. Now let's take a look at how this compares to a year's past before this. 2021, inventory decreased by 7%. 2020, it fell by 8%. So pretty wild to see that inventory was decreasing during a time when inventory tends to increase throughout the year. And that's, again, one of the reasons why I had all-time record high in home prices, right? 2019, let's look at pre-COVID levels. The year-to-date change, this is January through June of 2019, up by 10%. 2018 up by 17%, and 2017 inventory grew by 12%. So the average growth rate from January through June 2017, 18, and 19 was up by 13%, whereas this year it's up by 26%. So just taking a step back here, inventory is growing much faster compared to last year, but basically half the rate we saw in 2022. But it's also growing much faster compared to pre-COVID levels as well. The reason why I put this together for you guys, by the way, as well, is that when just looking at year-over-year changes, so for example, June this year compared to the average June in 2017 through 2019 is a decrease by 32.4%, which is exactly what Realtor.com stated right here, down by 32.4%. So that would imply that because we have such a low level of inventory compared to pre-COVID levels, we should see home prices continue to increase. However, when looking at the rate of change, which is something I follow closely on this channel here, inventory is up by 25%. So the change of inventory so far this year, January through June this year, compared to the average change for that same time frame, looking at pre-COVID levels, is up by 25%. So again, big picture, even though inventory is down greatly, down by 32% compared to 17 through 2019, the growth rate is up by 25% though. So this implies to me that we're not going to see runaway home price growth because inventory is increasing. And of course, it's rising much faster than last year, but we're not going to see the similar correction like you saw in 2022 because inventory was surging in the last half of 2022, frankly, starting in May, whereas this year it's basically increasing at half that rate. So it's possible we're going to see home prices decrease in the last half this year, which is seasonal. We're not going to see this giant correction like we saw in 2022, though, because the rate of increase so far this year is not nearly as bad as 2 years ago. All right, going back to Realtor.com's latest report here, let's talk about pending home sales, a measure of contracts being signed between buyers and sellers. You place an offer on a house, you get your offer accepted, that is a new pending home sale. That actually increased by 2.4% this June compared to June of 2023. And that year-over-year growth rate of 2.4% is identical to the previous month back in May. They also mentioned here that with rates falling and inventory increasing, it's possible that home sales could accelerate slightly this year. Now, speaking of rates, this is actually some big news that just got announced on, or was reported on Thursday. The average 30-year fixed rate decreased to 6.85%. That's a decrease of 14 basis points compared to Wednesday. Jumbo loans around 7.09%. FHA and VA loans is around 6.3%. So looking at the chart over the previous several months now, at 6.85%, this is actually tied to the lowest levels we've had going back to March 8th this year. So in other words, the average daily rate, according to the Mortgage News Daily, is at a 4-month low right now, which could spur home buying activity, right? Also, compared to 1 year ago, rates decreased by 24 basis points. 1 year ago, the daily rate was at 7.09%. Now, the reason why rates decreased on Thursday was because of this right here. This is on investing.com. If you just Google investing.com, their economic calendar, you get this. And of course, I provide a link in my video description below for all the articles I share in my videos. So I'll share this link as well. Anyways, the reason why rates decreased by 14 basis points today was because of this right here. Core CPI, which is a consumer price index, which measures the rate of prices that consumers pay for everyday services, for goods and services. But core CPI strips out volatile food and energy costs. For the month of June, it actually came in below expectations. It only increased by 0.1% compared to the previous month. The forecast was a gain of 0.2%. Also, in the previous reading back in May, it increased by 0.2% as well. So the reading on a month-to-month basis was lower than expectations, but also lower than the previous reading as well. On top of that, the year-over-year change increased by 3.3%, below the forecast of 3.4%, also below the previous reading back in May at 3.4% as well. So because this inflation report came in lower than expected, showing that inflation is winding down, that is one of the main reasons why rates decreased so much on Thursday. Additionally, there's a lot of talk right now about when is the Fed going to start pivoting or decreasing the federal funds rate, which has an indirect relationship to mortgage rates. So here's the CME FedWatch tool. This is the Street's forecast regarding the Fed's changes to their federal funds rate, which is the overnight rate that banks charge each other, which does have an indirect relationship to mortgage rates though. The next meeting is scheduled for the end of July, 20 days from now. The likelihood of a Fed rate cut is at 0%, basically. The Street's forecast is at 91.2% that the Fed is going to pause, not decrease or increase rates in their next meeting. Then their subsequent meeting is scheduled for September 18th. Much different though, because by a 84.6% probability, the Street is forecasting that the Fed is going to decrease rates by 25 basis points down to 5.25%. This is much different compared to 1 month ago. 1 month ago, the Street's forecast was a 46.8% chance that they're going to decrease rates and also a 47% probability they're going to pause any rate cuts. Now it's at basically an 85% chance they're going to start cutting rates in September. Then fast forward to December 18th, the last meeting this year. It's basically kind of split between being at 4.75% and 5% by the end of this year. So a 42% chance we're going to be at a 2 rate cut cycle. So the Fed had decreased rates by 25 basis points twice this year, and also 3 times by a 45.2% chance. But what do you guys think about this? Do you guys think the Fed is going to start cutting rates twice this year or 3 times? It's basically split right now. In my opinion, it's all based on incoming data, especially regarding the labor market and inflation as well. In any case, let's get back to Realtor.com's latest report here and talk about pending home sales. So again, pending home sales actually increased by 2.4%. It's also pretty wild here that even though we have far fewer homes for sale compared to pre-COVID levels, we still have more pending home sales, which is right here. The brown line right here is this year, and I'll see pre-COVID levels is below right here. And in 2023, it's kind of tucked behind 2019. So even though we have approximately, 32% fewer houses for sale right now compared to the average June, looking at pre-COVID levels, new pending home sales are actually above pre-COVID levels. We're also way below 2022 though, 2020, as well as 2021. Therefore, how I would summarize this chart is that we still have a competitive market overall nationwide because pendings are higher compared to pre-pandemic levels, but we're not nearly as competitive compared to 2020 through 2022 at this time. And frankly, that's what we're seeing here in the Sacramento region where I live and work as a real estate agent in the greater Sacramento area. If a house is priced right, in other words, it's not overpriced, and there's not a lot of work involved, it's remodeled, then houses on average are still selling very quickly right now in Sacramento. All right, let's talk a little bit more regarding the supply side. So new listings increased this June compared to June last year, up by 6.3%. This marks the 8th consecutive month of increases of new listings after a 17-month streak of decreasing new listings on a year-over-year basis. So this year, we've been seeing new listings increasing year over year for 8 consecutive months. But before that, we saw 17 months in which new listings decreased compared to the previous year. One reason, of course, why we have a lack of new listings compared to pre-COVID levels is this right here. 87% of outstanding mortgage loans, in other words, 87% of people who have loans in their houses have a rate below 6% right now. And of course, that's limiting the amount of people who want to list their house for sale. If you have a rate at 3%, why would you sell and take on a 7% rate? Unless you have, life circumstances, you want to move to a more affordable area, you have a growing family, etc. But this is definitely limiting the amount of new listings we're seeing right now. Let's take a look at that chart looking at new listings compared to years past. So right now we're up by 6.3% year over year. But you can see here, compared to all previous years, 2017 through 2022, we're at very low levels. 421,000 houses were listed for sale this June, compared to, let's just look at 2018, 19, and 17. There's around 550,000 new listings. So even though we're up compared to last year was completely abnormal. The lowest levels we had in several years, going back to at least 2017 when looking at each of these months. Additionally, what I also noticed as well is that new listings have been actually decreasing for the past couple of months. Much different compared to 2022. New listings were surging through June. This year has been decreasing really for the past couple of months now. We can imagine a scenario in which new listings were basically going straight up like this, that would cause inventory to skyrocket as well, which of course would put big downward pressure on home prices. But right now we're seeing a lack of new supply in the market, even though we're higher compared to last year's levels. It is all about supply and demand, right? Also, let's talk about this as well, how each of the regions fared, because there's some very big differences here. So here's a look for the US as a whole: the Midwest, the Northeast, the South, and the West. The black bars are inventory changes compared to 1 year ago, June last year compared to June this year. The red bars are inventory compared to the average June in 2017 through 2019. So every single region has more inventory compared to last year's levels. The biggest increase actually was in the South, up by nearly 49%. In contrast, every single region is down greatly, down by more than 15% compared to pre-COVID levels. And in fact, the biggest decline is actually in the Northeast, down by a whopping 57.1%, whereas the South is only down by 17%. What's also interesting about inventory as well is that out of all the 50 biggest cities in the US, every single metro is up compared to 1 year ago. It says metros that saw the biggest inventory growth were actually in Tampa, up by a whopping 93.1% year over year. Orlando, Florida, up by a whopping 81.5%, and Denver surged by 78% year over year. Despite higher inventory growth compared to last year, though, most metros had a lower level compared to pre-pandemic levels. So for example, among the 50 biggest metros, 8 metros saw more inventory compared to pre-COVID levels. This is down from 11 metros 1 month ago. The top metros that saw more inventory compared to pre-pandemic levels were actually in the South and the West, which included Austin. Austin, Texas, they have 41% more houses for sale compared to 2017 through 2019. Memphis up by nearly 25%, and San Antonio, Texas up by a whopping 24%. What's interesting about this, at least I find this interesting, is that the metros that are experiencing the biggest increases of inventory compared to pre-2020 are experiencing the biggest decreases in home prices overall, which can be seen by Austin, Texas, one of the metros that is down on a year-over-year basis. All right, let's change gears slightly here and talk about how fast or how slow houses are selling. It says houses are spending more time on the market compared to last year. In other words, taking longer to sell on average, but less than pre-pandemic levels. So the typical home spent 45 days on the market. So you list your house for sale. It takes about 45 days to accept an offer from home buyer. So about 45 days on average this June. That was 2 days more compared to June of 2023. This marks the third consecutive month in which houses were taking longer to sell compared to the previous year. This is also contributing to the rise of inventory. So we're seeing new listings in the market, and also we're seeing houses taking longer to sell. We're also seeing pending home sales at relatively low levels as well, which is all contributing to the rise of inventory on a national level. However, the time a typical house spends on the market is about 8 days less than the average June from 2017 through 2019. So houses taking about 2 days longer compared to last year, but still selling about 8 days faster compared to pre-COVID levels. Let's also discuss asking prices, because on a national level, asking prices increased to $444,000 compared to last month at $440,000. Also, 1 year ago, we were also at $445,000 as well. So asking prices are flat compared to 12 months ago. Now, here's a look at a chart looking at asking prices going back to 2017. So right now for June, we're flat compared to 2023, which is in peak right here. We're slightly below 2022's peak regarding asking prices, but at $445,000, look at 2017. June 2017, we were at $280,000. Now we're up to $445,000. So asking prices have surged by 59% compared to June of 2017. Can you say a lack of housing affordability on a national level? Let's also discuss the share of price reductions, because that has been increasing as well. Last year, the share of price reductions was at 14%. This year, it increased to 18.3%. This is what caught my attention regarding this. The share of price reductions is at a 5-year high for the month of June. The only year in which the share of price reductions was higher compared to this year was actually in 2018, which is right here. Back then, the share of price reductions was slightly higher than the levels we're seeing right now. But right now, we're higher than 2017, 2019, 2022, 23, 2020, as well as 2021, when back then the share of price drops was less than 8%. Now we're over 18%. One thing that also caught my attention regarding this as well, and you guys should be aware of this as well, is that even though we're at basically a 5-year high regarding the share of price drops, look at the rate of change though. So to start the year, we were at just over 14%. Let's just say 15%. Now it has increased to 18%, a small increase of 3 percentage points, right? Compare that to 2022 though. The share price drops in January of 2022 was only 6%. By the time we hit June of 2022, the share price drops increased to 16%. So it nearly tripled from January through June in 2022, whereas this year, a small increase because we started already at elevated levels. And again, I hate to go back to 2022, but this is again one of the reasons why home prices tanked in the last half of that year because inventory was skyrocketing, which caused the share price drops to absolutely skyrocket as well, increasing to 6% in March, up to nearly 20% by the time we hit July that year. Before I wrap up today's video, I'm gonna provide this as well because every market's different, right? So for the 4 biggest regions nationwide, here's how they fared compared to 1 year ago. This is the Midwest, the Northeast, the South, and the West. So the biggest inventory gains are actually located in the South, up by 48.9%, whereas the Northeast saw a small increase, up by 12.5%. New listings increased the most in the West, up by 9.8%, and also increased the least in the Midwest. But every region has more inventory and more new listings compared to 1 year ago. Asking prices decreased in the South, down by 1.8%, whereas the Northeast surged by 5.6%. Now, looking at how this compares to pre-pandemic levels, drastically different, right? Every single region is down regarding inventory, down by at least 17%. Also, new listings are also down by over 14% as well. The biggest decline is actually in the Northeast regarding inventory, down by 57.1%. Also, we're seeing big decreases of new listings in the Midwest and the West, down by nearly 30%. Asking prices have been surging by over 35% for all these regions as well. By the way, Realtor.com also provided how each of these 50 biggest metros fared as well. And I won't provide that analysis because this video would be 15 hours long. Instead, I'll provide a link in the video description below so you guys can take a look at this article. But please leave me a comment below with your thoughts regarding today's video. Also, what are you guys seeing in your neck of the woods? Because of course, the data I'm sharing in today's video probably will be different than what you're seeing in your neck of the woods. So please leave me a comment below regarding that. Please like and subscribe. Hope you guys have an awesome day. I look forward to seeing you on the next video.